Welcome to Hubs and Drivers, a podcast for building product marketers sponsored by BLD Marketing. I'm Jeff Donaldson, your host. On today's episode, the AIA forecast for 2023, a look ahead. Thanks for joining us. Will we see a recession in 2023? It is a burning question and one that runs across every segment of the economy. That includes the construction sector. The American Institute of Architects, or AIA, recently released its semi-annual Consensus Construction Forecast. The findings are compelling, particularly for the commercial construction industry. And here to break down all the numbers and what they say is Dave Sladack, president of BLD Marketing. Dave, thanks for joining us.
Yeah, sure thing, Jeff.
So the AIA went deep here, and there are a lot of numbers to break down. What is the opportunity that might be ahead in terms of the AIA forecast? What's it saying? What's the headline, so to speak?
Well, the headline is, when's the recession coming? Okay, and we've, all of our clients, we have these conversations continually. I think everyone had this, this sheepishness about this upcoming recession that's supposed to, at first it was going to be the Q1 of 2023. Now it's projected to be between Q3 and Q4 of 23, maybe even into 24. Nobody knows for sure. And so what we've been doing with our clients is just saying, look, let's take a look at the market, let's dissect it, and let's look for opportunities. Even in a recessionary time, there are opportunities, and that's what we'll talk about today.
Yeah, and I know that you want to dive deep into each of the different sectors. In terms of industrial, what are they saying about the industrial side of the business? What are the opportunities there?
So the last forecast that came out from AIA, and which is an aggregate forecast, and they use a number of different sources. So like everyone from Dodge Analytics to Wells Fargo to a group that we utilize for our own primary customer research, FMI Corporation. And so they take all of that data together and then they publish this forecast twice a year.
So it's aggregated.
It's all aggregated. So the last one that came out was December of 22 for the 23 and 24 markets, okay? Or I'm sorry, years. And industrial's the star. Okay, so industrial, what they're saying is it's going to have a pretty high year-over-year growth rate, like over 15%. If you look at FMI and what they're saying, they're very consistent with that. FMI is a resource that we like to utilize independently of the aggregate because their data is pretty reliable, and they update it quarterly too. But if you look at industrial, why is it growing and why is it projected to be a plus 15%? Well, a lot of different reasons, okay? You're seeing a lot of reshoring of manufacturing now because of the geopolitical situation that we are faced with. So like and it's not just the United States, but a lot of countries are now trying to develop their own manufacturing, becoming a little bit more self-reliant. So you're seeing that as a result of that, and coming out of the pandemic, there's a shortage of warehousing space. And so that's driving growth in that specific segment. But overall, when you look at what's driving from 23 through 25, you have to look at what the government's doing. Okay, they're providing a lot of incentives for power, utility, green energy, microchips. Again, a lot of this is being resourced to domestic production too. So a lot of infrastructure too with the government incentive and stimulus bills that recently came out as well. So the combination of all of that looks for a really, really strong year, not just in 23, but going into 24. And it's funny. You look at industrial that the 15% that's the AIA is forecasting. FMI is even more bullish about it. Now, granted, we're almost halfway through 23, but They're projecting of a 27% growth year over year in the market, and they're seeing it continue through 2024 at a 9% click. Now, the downside is you still have high interest rates. You still have labor issues. So labor availability is only going to take you so far with regards to how quickly those projects can be started and completed.
Hotels and resorts, another key sector to look at. Now, of course, during the pandemic, during the shutdown primarily, travel was completely restricted. People were staying in their homes. They weren't traveling. There wasn't that leisure type activity that's available, but it looks like there's quite a bit of growth ahead.
Yeah, I think there's a delayed gratification with that industry. Coming out of the pandemic, first of all, they got hit incredibly hard with the pandemic, obviously, right? So, and they lost a lot of their labor force. So they've had to rebuild that. So if you've traveled at all over the last 18 months to 2 years, you can tell there are a lot of differences in maybe what your experience has been like staying at a hotel or a motel. You don't have the same level of service anymore. Staffing models are a lot different.
You have to let them know if you want them to come in and clean the room.
Absolutely, but I think customers are adjusting to that,
Sure.
and more importantly, the industry is adjusting to what this new market is going to look like. You're seeing a lot of consumer travel coming back now. I just saw a stat the other day, the summer of 2023, they're going to be comparable to 2019 levels as far as travel goes.
It's almost come back full tilt.
Well, I think what's happened there is, through the pandemic, a lot of folks put a lot of their discretionary dollars into home improvements.
Right.
They were spending more time at home. They saw the blemishes. And coming out of the pandemic, number one, they've been boxed up for so long, they want to get back to some sort of normalcy with travel and go back to experiencing things. The other side of it is interest rates have increased. So home selling's obviously on a decline for
Sure.
2023. So that means people aren't moving, so they kind of have their projects for the most part done in their homes, a lot of homeowners. And so now they're going back to some of those normal travel patterns for their entertainment and vacations and so forth. On the business front, you're seeing a return there too, but it's a different type of return. It's not going to be where it was like in the pre-pandemic era. I think a lot of companies have gotten smart with travel budgets plus technology. So there's a better balance between, okay, what can we do to be more efficient? Through a Teams call or a video conferencing versus going to visit someone. However, if you talk to any salesperson in the industry that we work in, getting out there and just having those face-to-face conversations is absolutely critical.
And I think in many ways the pandemic emphasized that because we were so restricted and weren't able to interact on a personal level that people want to, in some cases, get back to that, at least when it's budgetarily appropriate, I guess.
Well, just like employees coming back to the office, it becomes a transactional relationship if you don't get to see people and have dinner with them and so forth. So it's very similar with a client in a brand perspective. But the growth overall in 23, the AIA is projecting like almost a 10% growth. They're expecting it to sustain itself in 24 at 5.3. You look at where FMI's at with it, and they're pretty consistent, although I think they call for a slightly larger opportunity in 23. It looks like year over year is at 16%.
So how about healthcare? We've got an aging population. It looks like that's on the upswing as well in terms of the AIA forecast.
Yeah, healthcare is always consistent. It's one of those institutional categories where, for a lot of factors, you're always going to see some growth there. What's driving growth more immediately now is, one, we have an aging population. Secondly, what you're seeing is a change. A lot of the hospital systems who really, control a lot of the healthcare infrastructure spending, traditionally located in downtown urban areas.
Right.
So now what you're seeing is a lot of these micro hospitals being built in more community footprints.
We're seeing that here in the Pittsburgh area.
Absolutely.
Both healthcare systems have begun
And there's
to
a
do
number of things driving that. One, there are less expensive real estate spaces, so it's easier to afford. And you have to remember, hospital systems run on pretty lean margins. There's a high operating cost with a hospital system. So anywhere they can find some sort of, they can recoup some sort of margin, they will. The other thing is, it's just a matter of convenience, right? Folks don't want to go downtown, just like workers aren't going downtown anymore. Regular citizens are the same way. And a couple of things are driving that. One, matter of convenience, just to go to your local place, get the services you need and get out, okay? You don't have to worry about parking. You don't have to drive through the downtown areas. But secondly, obviously a lot of seniors use healthcare. Right. It's easier not just for the seniors to get to their destination in a community hospital, but their caregivers,
right?
Their kids, whoever's taking them, right? And so, you have the Gen Xers and maybe some older older millennials who are quite busy with their careers and families and so forth. So their time is important too. So it just gives everybody a little bit more easier access.
How about amusement and recreation? In some sense, we know hospitality is on the way up. Looks like amusement and recreation, there's some opportunity there as well.
Yeah, so just like healthcare, which is like projected at like 5.5% growth in 23, amusement recreation's at 5.3% year over year plus. And what's driving that more than anything is, again, it goes back to the consumer. They've been holed up for a long time. They have some of their own capital expenditures already done, like on their homes and so forth. And so, there's still a strong discretionary spending out there, even though there's a pending recession. And people want to have experiences. You look at the millennials, they're all about the experience. Gen Zers are all about the experience. But even Gen Xers now, they want to return to things like, going to the ball games, going out to restaurants, and that's where they want to spend their time, right? The other thing that's driving that from a negative perspective, though, is you look at like where a lot of like amusement construction happened market to market, it were with casinos, brick and mortar casinos. That drove construction over the last 5 years or so, or maybe a bit longer. That's slowing down because you're seeing now some regulations have changed with all the states and so forth as it relates to gambling. So you're seeing a lot more online gambling come into play now. Yeah. So that's a challenge potentially, at least for that one sector of the amusement category. But overall, it's projected to hold its own throughout 24.
What about public safety? What's the outlook there?
Yeah, public safety, again, driven by some of the infrastructure spending and investment that's anticipated here. You could break down some numbers. Overall, in 23, AIA, the aggregate forecast has it at almost 5% year over year. And if you look at the U.S. Census data, their May report shows March spending, and the March spending indicators like $11.2 billion in spending, which is up 2.9 from just a year ago. And that's just as 2023 is getting rolling. So there's a lot of momentum there with the public sector, particularly in public safety. I think the con side of that is there's a lot of dollars being allocated right now. The question is, it has to roll down to the state level, the local municipal level, has to get bid, has to get placed, approved, bid, placed, and then you have to find labor to be able to do it all.
Right, so there are plenty of hurdles to clear there. Education is our next sector. We saw some perhaps temporary shifts during the pandemic where students were delaying their education, particularly when it came to four-year degrees. A lot of students, I have college-age kids. They weren't among them, but there were a lot of college-age students or students who might be considering going to college going, I don't want to pay that amount of money for a remote education. Yeah. I'm going for a college experience. Now, obviously, we're back in person at universities and colleges. What's the outlook for education?
Well, you have to break it down. When you look at post-education, colleges, four-year colleges, even 2 years, enrollments have been a challenge. Kids don't want to come back. They're really reconsidering the value of a four-year education. I mean, not everybody, of course, but you're seeing enrollment's really being challenged to get back to where they were pre-pandemic. I mean, you're talking about anywhere from 10 to 25, 30% decreases in enrollments. And it's hitting everything in the post-education world. You look at community colleges, enrollments are down. Regular 4 years, regular 2 years. So it's a little bit of a struggle. Part of the issue there too is, aside from just getting that interest back and seeing what the value is, costs for colleges and universities keep increasing immensely. I think they've got to figure out some things internally. Their administrative costs and investment are almost outgrowing, the amount of actual professors and teachers that they have. So, that's also it's a headwind they're facing for sure. However, education has its opportunities. If you look at the K through 12, there's a lot of interesting things happening there. You look at overall, for 23, they're projecting a 3% increase. That's driven mainly by that K to 12. So what's driving that? One, demographic changes. People are shifting where they're living. A lot of folks are moving out of urban areas. They're moving out of states to other states. And so that causes some infrastructure investment, right? The other thing that's happening is private education. So coming out of the pandemics, private education, especially like, Catholic schools, things like that, there's been a new emphasis on that. The enrollments are back up, and they're in a mood for reinvesting in some infrastructure.
How about retail and other commercial? That's how AIA classifies. It looks like there is some optimism there.
There is, and it's a cautious optimism. I think you have to look for opportunities within that category. What you see a lot of is like a lot of mixed use development going up. So it's a combination of, some retail, some smaller commercial, and some residential mixed into it, multifamily. And so that seems to be the magic potion right now for that category. But it's not there's some of it in the urban areas, but a lot of it is in more of the, the suburban areas where they're just seeing that shift. Folks aren't going into the urban areas for work, so it's easier for them just to connect in their own communities. That's not just happening in suburbs. What you're also seeing, I just read an article yesterday in the Wall Street Journal, you're seeing similar types of development now outside of the core urban areas in downtowns, like not necessarily in the Manhattan, but like a Brooklyn or in like, some of the smaller cities, kind of like the city neighborhoods surrounding the main office urban areas. And you're seeing a lot of growth there. That's driven mainly or fueled by a lot of like younger folks graduating from college, wanting to have that more social experience, more of the access, more of the urban flair without having to go into the downtown areas.
Right. Religious and office are the remaining two sectors I know we want to look at. And it looks like, I hate to offer up the headline, but they're in the red to some extent.
They are. the trends macroly weren't in their favor before the pandemic. There's less folks attending religious services and things like that. So the need for infrastructure really hasn't been there overall. The pandemic really just took it to a whole different level. So it'll be tough to see them recover. Now the AIA forecast has them relatively flat, only like a 0.4% decrease year over year in 23, and then the early view in 24 is about a 0.2% increase. So I'd say it's overall flat. Overall, I just don't think there's a lot of activity there.
And how about office? We know that in many cases, the owners or the employers who had massive commercial spaces for their headquarters or for their teams, they went to school on the pandemic, and they're rethinking that space. And so many developers are now looking at reimagining what was commercial space into residential space. What's the office market look like?
That's exactly right. I mean, the AIA forecast has it relatively flat, 0.05 for negative 0.05 year over year for the office space. The FMI forecast for 23, they actually are a little bit more bullish. They say +5. I think the opportunities there, I mean, everything you said, folks aren't back to work full time. There's a lot of vacant space. I think the opportunity in the downtown spaces right now are for some retrofits, it seems, and turning some B and C class space into A space might be an opportunity, but it's going to be very, very select. Where you are seeing it is in the urban areas, but maybe building those suburban offices, that's where the real opportunity is short term. And then within that category, there is one really shining example of where there's some growth, and that's data centers. And they're typically in more of a suburban area.
So we've talked about so many different sectors, and obviously there's a lot of opportunity out there. What's the big takeaway for you when you look at this data in totality?
I think, just as I mentioned early on in the conversation here, I think you have to look at individual segments. There will always be opportunity in this industry. But it's going to shift. Some, like institutional, stays rather consistent, but others, you just have to look for where the true opportunities are. I mean, even on the residential side, we've got a lot of clients who they're mainly commercial, but they have a strong multifamily, push. And multifamily is probably the shining example on the residential side for a lot of different reasons, where there's some opportunity to build. So, our recommendation to our clients is, hey, look, and we do this, by the way. We use a number of different pieces of data. Often we'll have clients that might subscribe to like a Dodge analytics, and then we'll marry it up with what we know with FMI and with AIA. Right. And then we come up with a priority of, kind of saying, okay, based upon where your total sales are, where your volume is, and the projections that we know, let's together create some priorities. And instead of trying to focus on the entire commercial or entire residential markets, let's really pick and really segment it out, and then build assets and a whole campaign around a specific segment like education or a vertical segment like healthcare.
So you're super targeting or hyper targeting.
Correct.
Very good. Dave Sladack, President of BLD Marketing. Thanks for your analysis today.
Awesome. Thanks, Jeff.
Something that will continue to impact the pace of commercial construction is, of course, the shortage of skilled workers. According to a study recently released by the Associated Builders and Contractors, the industry will need to attract more than 500,000 additional workers in 2023 to meet demand. And just to be clear, that's on top of the normal pace of hiring for the year. Quite a hill to climb. Hey, would you like us to cover a specific topic on an upcoming edition of Hubs and Drivers? Well, email us. The address is info@hubsanddriverspodcast.com. That's info@hubsanddriverspodcast.com. And make sure to follow and like us on YouTube or on wherever you listen to your podcast. That's all for this edition of Hubs and Drivers. I'm Jeff Donaldson. See you next time.